Okay, there we go. I think that all right. Okay, so if you guys do have a comment, let's see. Okay, there we go. Okay, it looks like that I'm all good here. Now that I'm about 1 minute live in, what I'm gonna do here tonight is I think that I can see your guys' comments. I'm not 100% sure. What I'm going through is I'm actually going through StreamYard right now. First time I've ever used this software, so any sort of patience that would be really greatly appreciated. Thanks for showing up tonight, though, guys. This is the first time I've ever done something like this, so it's kind of a learn as you go. It's one of those things where it's just like, I don't know how to do it, but I guess we're going to figure it out as we go along. So, what I do know that I can do is that I did come up with some sort of talk track, I guess, for things that I wanted to talk about tonight, specifically things around the markets, and then also a couple stock picks that I think are really going to be important. Oh, there's Krishna. Okay, Krishna, thank you for commenting. I can see you. I can see your comments. I can see all your guys' comments. Um, as we go along, if you guys have any sort of questions, just let me know. This is really made for the Savvy Trader subscribers, so that I can interact with you guys and do a live Q&A, go over something, go over stocks if you guys want me to go over stocks, go over certain types of markets or whatever it might end up being. I'm here for you guys. So, all right, let me see if I can figure out how to do my screen share. I think this is okay. Not exactly sure how to do the screen share because I should be able to do share. Oh, okay. Well, that was going to be, let's not do that one. Let's try something else. Screen share. That was asking me if I wanted to actually open up something. Okay. How about this one? Perfect. I think that what we can do here, so you guys can see that. All right. I can see it on my screen. So these are obviously going to be a lot of the stock positions that you guys end up seeing here on Savvy Trader. Um, what we can do is I think that I can go over a couple, like what I'm basically thinking about the markets. Obviously, you guys have seen me, followed me for like the past year, and this is my performance so far over the S&P 500. So you can see that there's quite a bit of alpha. But to be fair, I ended up starting this at the bottom of the stock market. So like went in the depths and the doldrums of the bear market is when I started my Savvy Trader, more or less just to really show people it's like, hey, sometimes you really gotta take a risk and you know buy stocks when they're down. It's so pop. It's That's what's so interesting is that when stocks are going crazy, people always want to buy stocks, but whenever they're going down and they keep going down, you almost could like hold a gun to somebody's head and they still wouldn't buy a stock, which is just the craziest thing. And then obviously we can take a look at the performance of the QQQ. So performance over both the S&P 500 and the QQQ. Um, it's good stuff. Even after the recent sell off that we expected in January, so that was pretty optimistic that we ended up seeing there. So let's go over the stock market, and what we're expecting. I think um, when it comes down to the stock market, I think that the story that I'm seeing out here today is really going to be more so around valuations. Let me actually go to Substack, because I think that it's going to be very important to actually see, like, look at what I'm looking at. So, Jam and Ball is going to be somebody who I end up following quite a bit. This helps me get a better understanding of where stocks are currently, like from a valuation perspective. So when you can see, so like when you actually see that stocks are overvalued, this is obviously tells me take less risk. If their stocks are undervalued, that tells me take more risk. Okay, so what I think is, so first let's go over software stocks, and then let's go over the S&P 500, and then really put into context on like some of the risk that I'm seeing out there. So the reason why I think that right now we're in a period of what could be elevated multiples. So there's going to be a lot of people who could think it, I'll just show you. So here we are today. Right now, the top five median are trading at about 17.5x. This is directly correlated, or this is similar, I should say, to the end of 2017 and then early 2019, 2018. So the end of 2017 and the early 2018 you guys know what I'm trying to say. But what this is, so the reason why this is important is that when you think about what the historical valuations of stocks are, especially software stocks, they are historically valued on a next 12 months EV to sales multiple. What you're really seeing and what you've really experienced is that the best of breed growth stocks have received quite a bid since the October low, where I think that we ended up buying quite a few stocks on the Savvy Trader account. But we're definitely elevated right now where you're seeing that high growth median now at about 15.7. This is directly this is similar to the 2018-2019 timeframe. At first glance, this can look really expensive, but I'm not exactly thinking that it is too expensive here. And the reason why is that when you actually see the next 12 months EV, it's an or the free cash flow multiples, is that it is still relatively in line historically. So what ended up happening like in the 2021 timeframe is that a lot of unprofitable tech ended up catching a bid. This is why a lot of people ended up getting blown out in the 2022 bear market is that they were invested into that unprofitable tech. But you see stocks like CrowdStrike, Zscaler, or even Mercado Libre that are pushing all-time highs now. These are the companies that you're going to want to really focus on when you think about like from a profitability perspective. Um, so a lot of the best of breed growth stocks right now, even though that they look expensive on an EV next 12 months, EV to sales next 12 months multiple, they're really not because of the way that they optimize their bottom line metrics. So that's why I ended up buying MongoDB. If you guys were following along with that, I ended up buying MongoDB at about 200 or $360 per share. It was about 12x next 12 months EV to sales. But because it was, even though it was 12x, there's definitely a possibility here when that we're actually going to see a period of elevated multiples, just like in 2018 and 2019, for a longer period of time throughout 2024. Okay, and the reason why that is that when you think about it from a macroeconomic perspective, because you guys know my style, where I like to try to marry technicals, macroeconomics, and business fundamentals all into one to really draw a generally good conclusion about where I think the stock market is going to go over the next, like, let's say 6 to 12, 18 months. So when you think about what bond yields are going to do, I think that what we got to look at here is there's two big data points. First one is going to be overnight reverse repos. And then the second one is going to be the 10-year, 2-year yield curve. These are two things that I'm watching, and they are very important, and they are not talked about nearly enough, which is so I think that that's really interesting is that despite how important these are, because right now the yield curve is uninverted, and nobody's even mentioned this on social media anywhere, on YouTube or on X. But you can even see that during these periods where the yield curve is uninverting, this when it uninverts, it usually happens. So you can see May 2009. It usually happens just a few months before the economic recession actually hits. So what this is telling us is that right now the market looking forward 6, 9, 12 months down the road is that we are actually positioned to go into a recession despite the overwhelming consensus that there's going to be some sort of soft landing. Now, the soft landing narrative compared to like the the hard landing and the no landing and whatever, it doesn't matter. So the only thing that really does matter is that number one, the prices that you pay for the individual investments, and then number two, it's going to be what those businesses could potentially do during the economic recession. So even though that we are seeing that there's a very, very, very high probability that there's going to be an economic recession within the next 12 months, because you can see, like I mentioned, is that usually the yield curve uninverts a few months before the recession. So you can see right here, May 2007, recession started in December or January 2008. So it was about 6 to 8 months later. Right here, same thing. December 2000, the yield curve uninverted. Recession, boom, March 2001, so 3 months later. Same thing right here. Yield curve uninverted. Let's just call it like the yield curve uninverted right here in this area. June 1989, the recession hit a year later in July of 1990. Obviously, it danced around in this area, but as soon as it started steepening, and once the yield curve got steeper, then we actually ended up going into that recession. And even back here in the inflationary regime, exact same thing. Now, why is this happening? Okay, so follow me here. I'm going to open up a few different pages. So when we look at the unemployment rate, with the Fred, right now we're at about 3.7%, which is saying there's no recession right now. But it's not about what the unemployment rate is today, it's where we're trending to, right? So when you think about what the unemployment rate is going to be, it's really about where's the monetary policy today. Okay, this is really hard to describe because it makes sense in my mind when I can picture it, right? So when you think about it from like an economic cycle, a monetary policy perspective, and then the economic data that we're currently getting, right? So as we go along the economic cycle, when the economy starts to deteriorate, what we end up seeing is once unemployment starts going up, then it's almost too late. That means that we've actually gone down this like a hope framework, and the employment data is going to be that last shoe to drop, basically. So once the unemployment rate actually starts going up, then that's when you know it's too late. And then the Fed is likely going to overreact and cut rates a lot more than what we are currently priced in to do. But what the jobs or not the jobs market, what the bond market is seeing right now today, that they're actually seeing that there is that deterioration in the economy. And this another way to look at this too is it's actually going to be PCE inflation. So when you look at the PCE inflation, let's see if I can actually pull this up the first time because I don't look at PCE inflation all the time. This is from December. We'll just edit this graph, percent change from a year ago. Okay, so when you look at the PCE inflation in economics, there's this thing called inflection points. So when monetary policy is currently restricted, or it's when it's in restrictive territory, I'm gonna just check your guys' comments real quick just to make sure. Okay, it looks like Sam is looking at right now, plus the bull steepener. When monetary policy is restrictive, what this basically tells us is that the only way to change the direction of the current economic trend. So in this particular case, PCE is falling, and it's almost at the Fed's 2% target. Now, this is November 2023's data. We're likely going to get, I think it's not this week, but next week, the PCE data for December, which is likely going to come in below 3%. So when you look at, and then also it's worth noting too that I think that 6-month annualized for PCE is like 2.6% right now. I'm pretty sure that's what it is. Nick Timiraos on X is going to be, you can actually still do Twitter right here. Nick Timiraos. Now you guys can see all my notifications there. Fun, right? I think that he did a really good, so like right here, he always posts these 3-month, 6-month, and 12-month annualized inflation metrics. This is really helpful because what it does is it actually tells us what the current trend is. So like right here, you can see CPI. This is headline CPI. The 3-month annualized changed. It obviously went down, but all of these are hovering at about low 3%, mid to high 2%. And when, like I mentioned before, when you combine that with the current trend of PCE, the only way to really reverse the current trend that we have is if monetary policy actually transitions from restrictive to accommodative. So I know that there's a lot of narratives going on out there, specifically around like deficit spending, and it's actually really concerning. That's something that probably keeps me up the most, keeps me up at night the most is the level of deficit spending, and I can actually show you guys that too. Is the level of deficit spending that the U.S. government is doing, and then actually starting to see economic weakness. Like that's pretty unprecedented to even think about that. That they're, I guess this is not. Oh, this is the Fed surplus or deficit. I can't pull it up right now. I don't know exactly how to Google that, but it's really concerning to see that we're currently spending so much more than what we usually do from like an equal budget, right? So like a balanced budget is the best way to think about it. I think that our deficit right now is like 1.5 trillion annually. This is typically this kind of deficit spending is typically going to be done in recessionary climates, but we're still transitioning towards a recession, even though that the consensus narrative right now is going to be that soft landing. So I mean, I could talk about this all day. Um, I think that the most important thing is like, what does that mean for our portfolios, right? What does that mean moving forward? No, you guys can see, like I mentioned before, that this is my current portfolio performance. But if a recession does hit, I do expect to underperform the markets for a period of time. And the reason why I don't plan on selling during that and more or less just slowly accumulating and buying the dip is because of how hard it is to project where the markets are going to decline to. So what I like to use when I'm going to gauge out exactly how far the markets could decline is I really like to take a look at, let's try to clean this up here. Is I really like to take a look at technicals because technicals are important. So this is going to be the S&P 500, and there's two moving averages that I watch the most. That's actually going to be the 200-day moving average and the 200-week moving average. And the 200-week moving average is one of the most under talked about moving averages. That it's kind of confusing to me as to why they don't ever talk about it. So um, we can even go back before this secular bull market, and we can follow the previous secular bull market all the way from 1970s to the market top. So you can see that the 200-week moving average acted as a major area of support throughout the entire secular bull market from 1970 all the way to the market top in 1999 2000. So what does that mean for us? And it's actually done the same thing too. So this is going to be our secular bear market, where we saw the 200-week moving average kind of trade sideways for a while. And then obviously it started right here in 2011 is when it recaptured it and retested. And then even the 2016 bear market, boom, touched the 200-week moving average, slightly above. 2018 bear market, same thing. This was probably going to be a much bigger crash than what we anticipated, but the Federal Reserve came in and did unprecedented QE of $120 billion per month, plus $5 trillion in deficit spending. Doesn't hurt the economy at all, that's for sure. So, and then even the bottom of the 2022 bear market, same exact thing. This 200-week moving average is money, guys. So what does that mean? If we go into a recession, what we're likely to experience is something similar to the 1990 bear market. So I've been really taking a look at this one for quite a while as to what I think the price action could look like. So pretend like this is our 2022 bear market, where during this time, it's very similar actually. During this time, inflation was rising. The so yeah, inflation was rising. The Fed was tightening rates, and what the response was is that the markets obviously crashed. And yes, the algos really sparked the severity of the crash and the magnitude of the crash. But once again, it touched that 200-week moving average and it reset itself. Over that time frame, about 2 years later, it basically just traded up, much like how we've been going through right now. But people are still very confused. Now let's take a look at let's correlate this here. Let's take a look at this yield curve. Here's a yield curve. So let's take a look at this yield curve during this time too. The 19, I don't think that that's actually going to do it too much justice. I'll touch up on that in just a second. I want to keep the train of thought and not go too far off here, because I'm really just talking along, and I know it's quite a bit of information here. Um, I'm thinking that what we could experience is something similar to this, where we have that 1987 crash, and then we also go back up, right? And we test all-time highs, and we may even exceed all-time highs. I think we exceed all-time highs this year. I think that we're going to probably finish the year somewhere around S&P 5,100, S&P 5,000. I'll touch up on that next. But then after that, this was the start of the recession. And you can go back here. This is 1990, and we can go back to our yield curve. And this is the 1990 recession. So you can see back in 1987, the yield curve was not uninverted at that point in time. It inverted, and then the 1990 recession happened in June of 1990. Go back to the S&P 500, June, July, right there, June, July timeframe. So July is actually Q3 of 1990. And you see that what this ends up being is this ends up being about an 18 to 20% stock market sell-off over the next couple months. I do think that if we transition into a recession, we're still going to follow the trend of the secular bull market, but I don't think that it's actually going to end up being something. I don't think that it's going to be a secular bear market type of move. So where would that put us today? If we follow a similar price action, what we can do is we can basically project out this 200-week moving average. We can take a look at, okay, so what it might end up looking like if we follow that similar trend is that we could actually experience something kind of like this. So we could probably go a little bit higher. Then let's say the recession hits in Q3 of 2024. I could definitely see a waterfall-like type sell-off because the recession hits in a 2 or 3 month time span. Not only that, but if you guys actually think about this too, that this is also the time that there's going to be a presidential election. So you're going to have the presidential election hanging overhead. We could experience, I'm not 100% sure, we could finally get our economic recession during that time frame. And with that comes a lot of uncertainty, all of that stuff all at the same time. Because even if we look at that yield curve once again, so if we go back to that yield curve, I mean, we're we're just a few basis points away from actually uninverting. Remember, like I mentioned before, it's about 3 to 6, almost like 12 months at most, 3 to 6 months before that the recession or the yield curve uninverts before the recession actually hits, and then that's when you actually start seeing that bull steepener. But I still think that this year is going to be a good year. And the reason why I think that is that when we take a look at Yardeni's forward earnings, so you can take a look at Yardeni's forward earnings forecast. I'm not exactly, they just changed their platform here, so it's really hard to actually be able to tell where to find this. Let's take a look at, yes, I'm not exactly sure how to find this because it's like, it gives like the S&P 500 earnings yield? Probably not. Okay, so I think that I can still remember it, so I don't need to pull this up right now. But analysts are expecting about 11% growth this year in earnings. But when we look at the forward PE here, and this is what's the most concerning, is that this is something that I feel like plugs. I should have definitely had this pulled up before because now it's kind of hard to talk and do this at the same time. Um, hang with me, guys. Hang with me, guys. So it's the US stock market. Like I said, they just changed all this stuff around. So sometimes I kind of have to poke through here and actually find out exactly what it is. Stock market valuation, equity risk premium, stock market PE ratios. There we go. Okay. So right now today, this is describing it best. So this is as of January 12th, 19, or we were at a forward PE of 19.6. In the event of an economic recession, and I hope that they do have, if they still have that just large cap. Yes, they do. Okay. In the event of an economic recession, we could actually see the multiple contract all the way down to this 14, 15, 16 area. What this essentially means is that what we have, if there is a recession, is that from a very like a multiple perspective, technicals aside, right? Because we think that that 200-week moving average is going to be that money point, right? So if we take 19.6 and then subtract that or divide that by 5, because we're thinking that we could possibly hit like 14 to 15. So if we take 5 divided by 19.6, what that ends up being is that ends up being about 25% decline in the S&P 500. So if we think about that from today's levels of 14 or 4779, so minus 4779, then what we're looking at here is about a stock market drop that would test the previous lows. If that was the case, if multiples actually ended up contracting. So I'm not 100% sure if that's something that's going to happen. I think that would be the lowest that we would end up going. hoping it doesn't, right? Not 100% sure. Um, I'm kind of running out of stuff to talk about, especially from like what I think about from like the stock market perspective. So I want to make sure that I take some time and answer any Q&A, or is there any stocks that you guys want me to take a look at? Let me know in the comments portion, um, because I do think that even though there's a lot of risk in the stock market today, especially from like what could potentially happen from a recession standpoint, I still think that there are a lot of stocks. So like I'll throw out a good one is DraftKings. I ended up buying DraftKings recently. So you guys can see that I bought DraftKings. I made it about a 4.68% of my total position. I started accumulating around $36 per share. I got it at right now it's trading at about 33. I did end up buying more recently, but why do I think that this stock is actually going to have a good year? So if you guys, I don't know if you guys have figured this out just yet, but when I always do valuation metrics. And I ran through all of the numbers here. And what I ended up doing is I actually looked at DraftKings Investor Day, and these are a lot of the numbers that I outlaid here. I'll let you guys take a look at that. What they ended up doing is they provided conservatism towards their guidance, and I think that even though even in the event of an economic like volatility, I do think that DraftKings is in a position to finish the year at about $50 to $60 per share, based on the metrics that they gave us, which is still quite a bit up. I mean, that's almost 100% upside from here if they do hit that $60 per share. And they just ended up opening up their Vermont. Was it New Hampshire? It was New Hampshire or Vermont, one of those two. So I think that that's definitely a stock right now where the numbers make sense, and you can even see like the EV EBITDA that I ended up providing right here. So I'll talk about this right here. Um, with the 2025, this is the EV EBITDA that they gave us, right? So that said that they think that they're going to do about $5.53 billion in revenue in 2025, and they're transitioning from unprofitability to profitability, or EBITDA profitability. 2025's EBITDA, and this was at a market cap that's a little bit higher than it is right now. I think, okay, their enterprise value is 18 billion, but today I actually think that they're closer to 15 billion. So this is actually lower than it is now. So it's probably somewhere around 17 or $18, or sorry, 17 or 18x forward EBITDA, which means that there's probably more upside. But when you have a market leader like DraftKings expanding their bottom line metric, growing 20, 25 or 30% compounded growth over, let's say, a 3 to 5 year time frame. I mean, this is where we're going to find our sweet spot, especially if we're thinking about like outperforming the stock market. I don't know if you guys use Seeking Alpha, but I use it all the time. So you can see right here too that as it stands here today, that 5.59 billion, this is consistent with their investor day, that they're thinking that they can actually grow 20% in 2025. This is probably going to end up being closer to my numbers once it all updates, especially. So I guess that's one stock that I'm really taking a look at right now, that I think that that DraftKings is set to outperform on a full year basis. What is the other stock that I think? Shift4. So Shift4, this is a very interesting one where their forward PE is actually 19.7. This is crazy to me. Like 19.7 forward PE at a 43% year over year growth. Like I think that I had a earnings, or I think I had a valuation on it, or a price target of it. I think that my wife is actually about to get home from the gym. That's why I'm distracted. I think that the price target was like 100 or $120 per share by the end of the year. This is just to have it at a 25 or 30 forward PE. And it's even more pronounced too if you even factor in like what it's going to be trading at the end of 2024. So Shift4 and DraftKings, and then Indie Semiconductor. I'm not sure if you guys have seen this one yet. The valuation on Indie Semiconductor is pretty crazy too. So you got 12.72 at the end of 2025. Like, if you think about, look at the growth too. I mean, and the real interesting thing too about Indie is that they are backlogged. So that means that it provides, just like Symbotic, it actually provides a lot of revenue visibility out into the future, where you can actually see what their revenue and their bottom line metrics are going to be for like 2, 3, 4 years. It's super rare to actually have a company that can do that. So I'm pretty confident they can actually hit that 55 cents EPS number with that 45% growth. I mean, I think that they said that in 2026 they can do somewhere around 650 million, or yeah, $650 million in an annual revenue run rate. That's what they call it. Much like software, but it's not software. They contract out their revenue. Indie Semiconductor, Shift4, DraftKings, I think are all like they're all positioned out great to actually be able to beat the market even in the event of an economic recession. So I think that the economic recession, yes. Do I think that it's going to hit? Probably, just because history is our guide, right? So we have to be conscious of that. And I mean, I can talk about the markets all day, but like, where's the alpha going to come from? That's what we really care about, right? How are we going to outperform the markets? And I do think in these individual stocks that I'm mentioning, like DraftKings, um, and I mean, I can talk about all the best of breed names too that everyone always loves, like Zscaler, Palantir, right? Palantir, the, Palantir is so slept on even to this day. Like that's why it's one of my top positions right now. Is that Palantir has a very sticky business model. Okay, Simply Wall Street. I gotta show you guys this. Palantir has such a sticky business model that it's hard to replace them. Like once they're actually into your operations, it's almost impossible to get rid of them and replace them out with somebody else. So like if I were to make Palantir's business model super simple, think about it like because their AIP product took what they did before and brought it to life. So like Gotham and Foundry, those are their two products. What do Gotham and Foundry do? They basically provide a digital twin for battlefields and enterprises, right? So they provide an actual digital like picture of what the enterprise looks like, right? So basically, they take all of the data, let's just talk about from a company perspective, all the company's data, and then they are actually able to show the movements of not physically show the movements, but it actually records and tracks, and you can see the movements through a dashboard like Foundry's dashboard. And you can make very educated decisions based upon that. Their AIP product allows you to actually converse with this data, with this enterprise data, uh, which basically means that like you can talk to an LLM like ChatGPT, talk to your enterprise's data, and then that enterprise's so Palantir's artificial intelligence will interpret business intelligence real time and help the business leaders predict or prescribe certain so like it's called predictive and prescriptive analytics, what it's called. So it's predictive analytics in the sense to where it can actually predict out certain things based on your business's data, right? So like certain events. So for an example, like a supply chain, right? Like um, let's say you have a railroad, right? And so Palantir, right? Let's say that you have Palantir integrated within your enterprise and you're managing a railroad, and the railroad, like let's say one of the cars are going off course and you're not 100% sure like what's going to happen if that car, by car I mean train, goes off course, and what it's going to run into. And then more importantly, if it does run into something, how long is it going to take before it runs into something? And how do you need to manage your logistics around that? That's what Palantir's AIP product does, right? So AIP, you go into your large language model and you talk. Okay, Palantir, what's going on? Like you go into your LLM, give me the timeline of when this train is going to run into the next train. It generates an actual response, and it says, and then the AIP, it also not only tells you exactly how long it's going to take, but it also provides you with like 2 or 3 different alternative methods. No other company does this out there. Like this is why it's so integrated within the government, and this is why it's like the second biggest position. I mean, Palantir is probably one of the most exciting companies that I own, and it's not even just because like there's about 10 other people out there that are saying that they love the company. It's really because like not only just that. but it's actually going to be their profitability metrics and how they're expanding. So they're growing their top line. So let's see what the analysts got them. So they're thinking that 20% this growth, 20% next year growth. And they're also expanding out their bottom line metrics exponentially. So this year was 312%. This is GAAP earnings, right? So if you think about it like, okay, they're going to be compounding the revenue 20%, but I think it's actually going to be more. And the reason why I think it's going to be more is if you take a look at their quarter over quarter numbers from their boot camp initiative that they've been doing, like I don't want to go too super speculative because Palantir is one of those stocks. I think that it can actually be a lot higher than that. I think that they can grow 25, maybe even 30% this year. It depends on how much AIP traction that they're actually getting, but 25 to 30% does make a lot of sense. So I think that Palantir should, I mean, if it falls down to that $13 range in the event of like some sort of stock market volatility, you'd have to throw that one at the top of your list. Like if you guys don't already own something like that. Oh, let's see. Krishna, let's talk about Tesla chart. Ah, yes, Tesla. Okay. Tesla, let's pull that up. Elon Musk, if you guys have seen that today. Elon Musk recently announced that he wants 25% stake. What does that mean? So, got to follow his replies here. I think that it's going to be right here, this tweet. So this tweet is going to be on right now. There's a lot of conversation about this, and there's probably going to be a lot of volatility, possibly, because the headlines and what's going on are two different things. The headlines are likely going to say something like Elon Musk is uncomfortable growing Tesla to be a leader in AI robotics. They're probably going to stop there, right? But when we look at exactly what he's saying, I think it's very important to understand like what this part right here means, that 25% voting control. I think that what Elon Musk is communicating is that it's been very clear. Like I've been watching this guy for years. We all have. He's playing chess while other people are playing checkers, meaning that he's likely trying to push his board, or even like the SEC or somebody. I don't know. He's pushing somebody, the authorities at charge or in charge, so that he could get 25% voting control. This is the important thing right here, voting control, because he also ends up saying something down here. I put compensation plan in quotes. This is primarily about ensuring the right amount of voting influence at Tesla. What this means is that he wants 25% voting influence. He's not asking directly for 25% ownership in the company. He's saying that I'm willing to work something out within the compensation or with the structure of his voting rights. Not necessarily just being given like compensation package to boost him up to 25% equity. He's asking for 25% of the voting power so that he could probably, what I'm assuming is that so he doesn't get ousted like Sam Altman did at Microsoft / OpenAI, right? Because as they continue, and it's to me, like from my perspective, I'm thinking that this is really bullish because I think that he sees something that we don't see. I think that he's looking at it and he's thinking to himself like, okay, I see where, FSD is going. I see what's going on with Optimus, and they are making a lot of headway with that. I'm seeing like, and I'm sure that he sees and he knows things that we don't know. Maybe even closer to AGI than what would previously be thought of. And he's thinking, I need better control of this. And I would hope, obviously there's two reasons why somebody will want control. They want to do good or they want to do bad, or they want to prevent bad from happening, which would be underneath the good category. For me, I'm obviously an X user and I'm a Tesla guy and stuff like that. From my assessment of Elon Musk's previous behaviors and like everything that he's done with X, I assume that his love for humanity is going to be taking precedent of this, and he doesn't want the powers that be to overpower him in the future, which is why I'm thinking that he says right here, I'm influential with 25% stake, but I can still be overridden if 2 times the amount of people want to override me. which basically means that a majority vote would say, okay, Elon, we're not doing that. But I'm thinking that Elon Musk is actually wanting to um, do. I think that he's wanting to do good, but I also think what this means for the stock price is that there's been a lot of selling recently, and I'm not 100% sure how much downside is actually there. So, I mean, it could trade below the 200-week moving average, just like here and just like here. But right here, even before the run up, buying Tesla at the 200-week moving average or below has been a good idea since 2013. And this is why I ended up increasing my Tesla position about 20%. So I think that we're actually getting a little bit longer in time here with the StreamYard stream. So I'm going to finish it up here with this Tesla because I feel like I could talk to you guys about stocks all night here. And then Andrew, I'll talk about Fubo. That's actually a really good. That's been on my radar. Is that I think Fubo is getting pretty dang close to hitting profitability, which is something that needs to be talked about. But that's why I ended up buying Tesla at the 200-week moving average, because even in 2018, when everyone thought they were going to go out of business, 2019 timeframe, right? This is like a 50% decline in the stock price. Everyone freaked out. They didn't know what was going to happen. This isn't that. Elon Musk isn't saying that he doesn't want to. This is, in my opinion, this is short-term noise more than it is a business-altering decision. He's playing chess while other people are playing checkers because he wants 25% voting right in his company, looking into the future as this artificial intelligence, like Tesla's artificial intelligence, becomes stronger and more powerful. Because AI is the most revolutionary technology that we have. Like knowing what I know about what AI and knowing what other people know about AI, it's one of those things where it's like, who's going to harness the power? I think Elon Musk is basically saying, I don't want the powers that be, like political influences or big money influences, to override him and his decision making. And I think that maybe, yeah, sure, Tesla drops a little bit below the 200-week moving average. I mean, like I mentioned before, this is the point when everyone thought Tesla was going to go out of business. And buying at the 200-week moving average was a reasonably good idea. And then even here, when it fell down below, and then now we've been trading at that 200-week moving average. And I still think that even if Tesla does sell off, I can't see it selling off too far. I don't think that the stock price is. I think there's going to be a lot of noise around it, especially on X. I think there's going to be a lot of noise. I think a lot of people are going to be afraid. I think a lot of people are going to extrapolate what he said, take it out of context. But I do think that long term, Elon Musk is going to get his 25% voting rights. And I also think that, I mean, maybe it might be better for the company. Maybe it might not be better for the company. I'm in the camp of thinking that it would be better for the company because I do trust, I do trust business leaders because you know what their intentions are over like the politicians and the people that are behind in the shadows. Elon Musk is not in the shadows. He's very out there. So that's my personal take on Tesla. Long story short, I'm not super concerned. I think it's a lot of short-term noise that is almost always prevalent with this stock. So last company I'll talk about is I'll actually talk about Fubo for Andrew there. So Fubo is very interesting. So if you guys don't know what Fubo is a sports first streaming application. And I used to own this company when I was around 10, 11, 12, 13, 14, $15 per share. So I owned it in this area. I think I sold it probably right around here, definitely for a loss because I think my average price was like $20. So not my best choice and or best stock pick back in those days, but it's a very unprofitable company back in those at that time. Fubo today is actually achieving profitability, which is very interesting to see. And let's see if this actually pulls up here. Come on, Simply Wall Street, work with me. I really love this chart. Let's go. The future growth. The future growth chart is absolutely money. This is historical, and it should be right. What the heck? Financial health. Does it not have my future? Okay. That's interesting. So they're projecting that they're actually going to reach that profitability by 2025 is what leadership is saying, and that they don't need to do any more dilution. The way that Fubo has done this is that they have basically changed their business model away from that previous sports. There it is. This is exactly what I was looking for. Okay, this is the cash flow. So right now we're in 2024, beginning of 2024, and they're thinking that they can hit cash flow positive, and this is what analysts are thinking here, is about that mid 2025 marker. So Fubo is right now a $700 million company, and I don't own this company, not yet, because I want to do a little bit more research and I want to just hit the pause button because I do not like owning companies that are burning cash too much unless they're about to hit that profitability metric. What you notice with a lot of stocks is that a lot of people are in such a rush, like Enovix, right? Enovix, a lot of people are in such a rush to buy these companies and just go all in on them right now. Or like Navitas, right? I own a 2% stake in that company. I get it, but it's growing 100% year over year. Anyway, a lot of people are always in such a rush to buy these companies like Rocket Lab or buy these companies like Enovix or like these super speculative home run hits, and they just want them now. And especially when they start seeing the stock price go up, they freak out and they say, "Oh, well, this company's up 100%." Well, did you talk about how the stock price went from $2 to $4? You know, like $2 to $4 is a lot different than going from $2 to $200, especially with these smaller companies. So what I like to do to manage risk effectively is I like to make sure that they are in, like, let's say, eyeballs distance away from actually being able to hit that profitability metric. I think that Fubo is one of those long shot stocks that we can, like a Sentinel One type of move. So if you guys saw Sentinel One, when I said I was pounding the table, $13 per share, like Sentinel One's going to hit profitability within 12 months, and they are. They're actually going to hit it either quarter one or quarter two of this year, where they hit that cash flow break even. And the result has been that it's been one of my best performing stocks. So you can see right here at 68% is my total return. Same with like Palantir, identical situation. Right before it hit that profitability point, boom, I started buying Palantir, up 109%. Zscaler was just stupid. That was because of a Gartner downgrade or whatever. Like that was that was like anybody could have seen that. I was like, I don't trust you. Like Zscaler was too good of an opportunity. That's why I bought it so heavily, and how I'm cool with just letting it run. I think the Fubo has the chance to do something like what Sentinel One did and like what Palantir did. And I think that this is something that should be thought about and it should be watched. Okay, Krishna. All right, man. I'll do AMD. And then I got to go because my wife's about to get home and then she's going to make a bunch of noise. Okay. AMD. AMD is an extremely slept on stock right now. Like everyone is so okay. The best way to really describe like what's going on with AMD is that right now Nvidia is like the popular hot girl, right? But this is such a bad analogy. Forgive me, guys. Forgive me, guys. Nvidia is the popular hot girl. That's the best way to say it. It's like every guy in class right now wants Nvidia because Nvidia is the popular hot girl. AMD is like the one who's like coming into her own. I'm not going to go because I don't want to get in trouble, guys. But you know what I'm trying to say. They're coming into their own like they're a late bloomer. Does that make sense? So AMD is 110% slept on. Like what they did with the MI300X, it was the biggest flex I have seen, and people completely overlooked it. The MI300X is comparable to the H100, the NVIDIA H100. Their supercomputing chip is equivalent and in some cases even better than NVIDIA's, right? They're NVIDIA's GPU. And even though NVIDIA, yes, it does have a large backlog. Yes, it is a software company too. But NVIDIA has been playing, AMD has been playing catch up for years. And they did overtake Intel, and now they're gunning for an NVIDIA. I'm not saying that they're going to beat NVIDIA. That's not at all what I'm saying. But I am saying that Microsoft Azure and Amazon AWS have appreciated the stock prices of both companies substantially. And that's exactly what kind of initiative that we're looking at here. All right, guys, it looks like the wife is home from the gym. It might be time for me to get on out of here. Stock picks that we talked about tonight was AMD, Shift4, and gosh, I can't even remember. AMD, Shift4, DraftKings, ND Semiconductor, and Fubo. I think all of those companies should be on. I think Fubo should most likely be on a watch list, not an own. But a lot of those other companies, definitely take a look at that. And whatever happens with the stock market, it's what happens with the stock market. All right, guys, have a good one, and feel free to let me know what's going on in the comments, or send me emails and whatever you guys like to do. Have a good one.